In this week's update, what it takes to generate well above average returns, why most investors fail to succeed, and how I achieved a 29% return since April 2023. My name is Garry Davis. As always, this is general advice only. And please remember to like and subscribe to the video. Right, let's start with our normal market perspective. The indices over the week were a little changed, really. Not a lot happening, but well-selected stocks that I talk about all the time are performing really, really well, both here in Australia and also in America. Now, by number, they're just a tiny sliver of the market. You know, we're not talking broad-based significant gains here, but some stocks are. And that's the really important message that I try to get across every week. Do your homework, get organised, do it well, because these are the businesses that are pretty resilient to whatever the interest rates are, whatever government policy is, whatever crazy things governments are doing. They're reasonably resilient to that because they solve a problem, they facilitate progress at a great rate, whatever it might be. They've got massive tailwinds behind them and will have for years to come. Okay, so how do I go about selecting stocks? And secondly, and these two things go together, have the confidence to pull the trigger, because there's no point in having a selection process if you go weak at the knees when you've actually got to press the buy button. And most of the time, the buy button, the best time to press the buy button is not really when you feel like doing it. So it's very much about process. There's a formula that I use, a repeatable formula. It's about process to select the stocks, the entry process, and then once you're in them, the management process of, you know, where do you take profit? When do you leave them alone? When do you increase your weighting? All of those sort of things. And they increase your odds of success. The more organized you are, the better. And then you just need to do that for a period of time, either under your own steam or under the guidance of somebody else, to build that confidence. Because until you've built that confidence, all the rest really doesn't matter a great deal. Having an absence of confidence is completely understandable. So I don't mean to be critical in any way. And the vast majority of investors are in that position. And it's because they just haven't ever got on a track, consistent track for long enough with a repeatable process to generate that confidence. And when you look out there, there's just so many things that could go wrong. It's just mind-boggling. We always sort of feel like it's worse than it ever used to be, but it's actually not. There's been plenty of times in history when things have been really, really difficult, and probably a lot more difficult than they are now. So you've just got to get used to the fact that there's always going to be all these things out there that might derail the stock market. But you know what? If you look at the stock market over the last 100 years, it just keeps going up and up and up from bottom left to top right. So you've just got to accept that that's how it is. So the answer is not to sit there in a state of confusion and be put off by all the things, that might go wrong. It's a process of narrowing your field of view and just deal with the best of the best. It's not a hard concept to embrace. It's actually quite a challenging process to execute, but it's not a hard process to embrace at all. So, as I said, you must have, if you want above average returns, and they're available for anybody, but you must have a repeatable process and only focus on stocks that are operating in areas of highly likely strong business growth. So it's got to be strong growth, and it's also got to be highly probable. And the obvious areas for those, AI, all sorts of areas of technology, quite a few niche industrials, there's healthcare in there. Consumer discretionary, there's some amazing stocks in the US that have got fantastic businesses in consumer discretionary. And from time to time, commodities will have enormous tailwinds, and they can provide tremendous growth that is very, very probable. Now, if we look at the US market at the moment, the indices have become highly concentrated. Everybody knows that. There's NVIDIA's on everybody's watch list these days. And with all of the other mega tech stocks, it has become highly concentrated. And that creates its own set of issues. If we look at the Australian index, it's done almost nothing in 3 years. It's virtually at the same level it was in 2021. So if you are a broad-based investor, then, and you're wondering why you're struggling, then that's pretty much why. What you've got to have is a consistent entry technique, not just, here and there, dive in, bit of a tip, bit of a recommendation, bit of a gut feel. So let's hit this one hard. You can't do that. You've got to have a consistent entry technique that's heavily around managing risk. If you focus on risk primarily, then the profits tend to take care of themselves. It's also about being very clear about how you're going to set up your weightings, and also your exit techniques have got to be consistent. And hardly any retail investors do this because A, they don't really know how to do it. They've never had that exposure to it. And secondly, it just takes getting organised. And I think for a lot of people, investing is just something that you just want to get done, just deal with it quickly and move on to the rest of your life. But unfortunately, if you want to be a really successful investor and get above average returns, it's just not going to work. I think you need a certain level of immersion in the market to be able to spot the opportunities and deal with them in a very organised fashion. So where can investors turn to for strong returns? So let me show you this return graph, which is indicative of the sorts of stocks that I focus on and that I recommend. Now, this chart from Interactive Brokers is a chart of a real account. It's from April of 2023 to the current date, and it's up by 29%. And it's been a pretty good progression during that period. So why was that date chosen, April 2023? Well, that was a point where my focus shifted even further to just the best of the best. That was a point in time where there was a change in the operation of the fund, and my focus changed to not be constrained by some of the normal valuation metrics, to embrace the fact that some of the very best wealth compounders on the planet are priced through a different valuation lens. They are always on seemingly high multiples, but that's just the price that one has to pay for such strong, reliable growth. And if you look back in history, that's very much the case. So once I embraced that those opportunities were there as well, the results improved even further. Since inception in 2020, the fund had returned 57% in total, but 29% from April of 2023. And it's really liberating not to have to hesitate on pulling the trigger with these kind of, high multiple but high growth, highly assured stocks. Sure, you've got to be prepared to wait for a bit of a patch of price weakness, which is what I do most of the time. But at the end of the day, you just got to do it. It's about having conviction around the process that you're using. That's the key. It's the confidence, it's the conviction. So as I said, since inception in May 2020, the overall performance is 57%. So the long-term growth was already there. The fund was performing at a satisfactory to good level by all standards. But since I've further embraced this concept of growth and quality and not being put off by these seemingly high multiples, and I'll talk more about that when I get to NVIDIA in just a minute. So what are the chances that that sort of performance is repeatable? And of course, these results, you've always got to say that past performance is no guarantee as to future performance, and that's a very true statement. So what are the chances that this sort of performance is repeatable in some dimension? Now, I make no claim in that regard, but I do note that if you've got a very clear definition of your selection and management process, and you can repeat it, then it's likely that it's going to raise the chances of you producing above average returns. And that's all that we can do as investors, is do things and position ourselves to improve the odds of success. There are no guarantees. And if you don't do it well, you'll stand a much higher chance of losing money. There's no question about that. Just want to touch quickly on how these results were calculated. The performance figures, they are time-weighted returns generated from the Interactive Brokers platform where these individual accounts are operated from. They're from an actual investor's real account, so this is not theoretical. This is just not based on recommendations. It's from a real account where all the recommendations to buy and sell were accepted by that investor. So it's a true and accurate reflection of what I've been recommending. And it's just the process that I talk about constantly with my membership services, but also refer to just about every Sunday in this video. So anyone who's been watching this video for some time should know exactly what I'm talking about. Now, 90% of this portfolio has been locally in Australia. And during that time, in that period from April 2023, the ASX index was up a mere 8%. The other 10% of the portfolio was invested in the US. So this is well and truly outperforming the indices, and it's doing that for a very good reason. Now, I'll show you how I did that next, but first, just allow me to tell you how you can get access to the sort of stocks that are producing these kind of returns. So just indulge me for a few minutes, if I may. There is a managed fund structure, as I've been talking about, and that chart is a direct result of that. They're individual accounts. This is not a pooled fund situation. The account is in your name. You retain full control because of the way that it operates, but you get the benefits of all the work being done by somebody else. The second option is the Insiders Club, where very specific entry and exit recommendations are made for the same or very similar stocks as in the managed fund. The pool of stocks that I'm using to make recommendations, whether it be into the fund or whether it be into my membership services, is almost exactly the same. There might be some timing differences, but it's pretty much the same. Now, there is a great deal of support on execution because when members first come into the service, of course they don't have the confidence that I've been talking about to execute. So support on execution is really, really important. Just getting a recommendation service or a bunch of tips is not much of a step forward. It really isn't. The third alternative you've got is if you want to get to know more about how I operate, the methods that I use, then there is a $1 trial for 2 weeks into Portfolio Analyst. So there are the 3 return pathways that you've got available to you if you're interested. Now, let's just have a look. The Insiders Club probably needs just a little bit more explanation. So in terms of stock selection, and again, this is the sort of thing that I've referred to constantly for years in this video. It's about finding stocks that have got financial strength and highly likely financial strength into the future. It's about stocks that have got pricing power for varying reasons. It's certainly about stocks that have got great management because great management just gets the job done. And it's also about the longevity of that business progress because they've got barriers to entry to competition. They are in a virtually unassailable niche, whatever it might be. There's a whole lot of things that go into this. But they're all the important things that you've got to look at first. Don't start with some household name. The consensus opinion says, we got to own some of this and some of that. It's, just you got to move away from that concept. The next part is that I need to have extremely high conviction about how that company will perform over the next 2 to 5 years. Now, over that period, most of the time, if the company is performing strongly, then the share price will move, not always at the same time. And that can sometimes be the difficulty for the inexperienced investor, is looking at the share price, not doing nothing, but realizing that the good news is still to come. So that whole process of stock selection is what I've been talking about for quite some time. Secondly, if we look at the entry technique, I really favour splitting up the entries, a progressive entry technique. Try to do it as much as possible on short-term weakness because that, brings its own advantages. And this is where the confidence is critical and where people struggle a bit They know what they want to buy, but they just can't bring themselves to pull the trigger because of all of this stuff that's going on in their head. And that that can come from past experiences, that can come from the media onslaught that we're constantly exposed to. There's many areas where your confidence can be broken down. The next thing is the exits and the profit taking. I have 3 clearly defined exit triggers that I use for core positions. There's no ifs, buts, or maybes about it. It's not subjective. It's pretty clear. And it removes the gut feel decisions, which is where most people get into trouble. Over the years, the single most important question and the single most regular question that I get asked is about exiting, about taking profit or about getting out when a stock is going the wrong way. So it removes those sort of gut feel decisions. It allows the big winners to unfold over time. And the reality of successful investing is that you will make the bulk of your profits over the years in a very small number of stocks. Do not expect this to be nice and even, lots of nice, big, fat, juicy winners. Just doesn't happen that way. So the few that you get in your lifetime, you've got to let them run so that those really big gains can unfold. And it reduces your downside if you have entry and exit techniques that are very clearly defined and are not being driven by gut feel emotions. So that's a little bit of insight into the Insiders Club process. But of course, the best way to experience it is come and join it and see what it's all about. All right, let's move on to the American stocks now. The S&P and NASDAQ were both down just a hair, not much. The equal weight S&P 500 was down just under 1%. So we're back to the normal pathway again of the indices being led by a smaller number of large stocks. I foreshadowed last week that we might see some downside in stocks like Nvidia and semiconductors, etc. Well, that didn't happen. The big tech didn't sell off. There was just a little bit of added pressure. I'm not saying that there's none. And to be honest, a little bit of a correction or a bit of a pause would actually be really healthy. So I wouldn't take that as being a bad sign. And just be really aware of the media has really jumped on this bandwagon of Nvidia's too expensive. It's too overbought. It's run too far, too fast. It's got to correct. Danger, danger. Just beware about making that Nvidia assumption. And I'll come back to that in just a minute. Now, the US dollar index was higher at 105.85. The 10-year yield shot up again a little bit. I think it was about 4.25 last week. But the VIX actually went the other way and was down to 12.4. Let's go look at some charts. Start with the S&P. You can see we were trading higher, but ended the week down just a little bit. And the RSP, it's still pretty much sitting where it has been now would you really go back to about March. So there's really been no progress in the equal weighted S&P since March. But if you look at this chart, there's actually been quite significant progress. So that's just an indication of this concentration that we're seeing. The NASDAQ looking quite similar. Now, let's look at semiconductor index, SMH. It's really important. And as I said, don't be too quick to jump on this negative, because and I did this in a video 3 or 4 weeks ago where I looked at Nvidia and I looked at the growth and the valuation, and it's actually not a problem. There really isn't. And it's really just a matter of, taking off those blinkers that when you see a share price that does this, it goes from $150 to $300, that you think it just must be too expensive. And there's been a lot of negative press about this. So don't be too quick to jump on that, because there actually is a case, as I really started to embrace well over a year ago, that you've just got to look at these sorts of stocks, these absolute world-beating wealth compounding stocks. You've just got to look at them through a bit of a different lens. And if you use the same lens that you look through a Coles or a Wesfarmers or some stock like that, then you're just going to come up with the wrong conclusion. The bottom line is this. Markets have always paid up handsomely for highly assured future growth. Just look at CSL over the last 2 decades. Just look at a whole bunch of other stocks in Australia that have done incredibly well over periods of decades, and they've always been expensive. And everyone's always wrung their hands about the high PE multiples that they've traded on. You've just got to start to look at the market through a different lens. This is what I said about NVIDIA last week. This could be a classic reversal. So we were up here last Thursday and Friday. Could be a classic reversal, medium-term top. You get this downward spiral in the ETF market, becomes self-propelling, and we could get a very significant correction in NVIDIA, in semiconductors, in the US market, and therefore pretty much the whole world. I would say now, a week on, that possibility is now very, very low. Could it have been related to options expiry? I didn't think it would be, and it's turned out that it really wasn't. We got a little bit of selling on Monday, but then it immediately stabilised and went up a little bit. And the third alternative was that it was just a quick burst of profit taking, and I think that is where the overwhelming odds at the moment look. So I remain positive and bullish on what the indices are likely to do in America between now and the end of the year, but even more so on these stocks. If you can just start to look at some of these stocks through a bit of a different lens, then I think you'll see some amazing investment opportunities. And there's the semiconductor index versus the S&P. It's always a great sign of a healthy market when this ratio is heading up like this. And you cannot look at that chart and say that the American market is not in pretty robust shape. All right, let's look at the individual sectors. This is the US market over the last quarter. We've got technology clearly leading the way, communication services, another aggressive sector of the market next. Interestingly, consumer staples is a bit of an anomaly in the middle of all of these aggressive sectors of the market, and then consumer discretionary and healthcare. But yeah, that's the way the American market is set up over the last quarter. And we've got energy and materials very much at the bottom of the pack. If we look at the same thing in Australia over the last quarter, it's been led by information technology, healthcare, and the banks. Then we get small caps still struggling to gain traction, even though they've been presenting some amazing value for many years. And this, getting back to what I said earlier about the bit of a pivot that I made, or the embracing of looking through these high multiple stocks and not being so constrained by typical valuation metrics. Looking at a stock that's got a really appealing valuation and think, well, the price must go up. Well, for small caps, the prices haven't been going up for year upon year, and it just leaves you scratching your head. And so then when you come back and you realize how well these seemingly expensive but world-class stocks are doing, then it's a game changer. And at the bottom, we've got materials and energy, and that's really been part of the drag on the ASX 200. So that is the American market. Turning to the Aussie market, the dollar finished just over 66. Our index was down 0.4% across the week, and it's been flat since the 1st of March, the week ending the 1st of March. Our index has done nothing thanks to the drag from materials. But whilst banks have gone up and continue to defy their valuations, and I think I talked about CBA last week, all-time high historical PE ratios at a time when the growth is certainly forecast to slow. And that's the important thing, because that's what the market is pricing in. It's the forecast. It's not the reality, because we haven't got there yet. So the forecast is for slowing growth, but the PE is at a significant historical high, and that doesn't make a lot of sense to me. Materials under pressure again, but there are a few gems that are trending very, very nicely, particularly in the precious metals area. So the question is, as we exit FY24, was this the final burst of tax loss selling? Or is it the reality coming home that our economy is in such a position that we're going to get an economic drag on earnings, and the market is sniffing that out ahead of time? I don't know the answer to that, but I am certainly concerned about companies that are heavily dependent on the health of the Australian consumer and the health of the Australian economy to do well. That concerns me a great deal, and I don't think I own any stock that ticks that box. All right, let's have a quick look at the Aussie market. So there's the index on a weekly chart. So we're at the same level that we're at back in March, and only fractionally above where we were in 2021. So very little progress in 3 years. Just while I'm here, let's look at gold and silver. There's a silver chart. We broke out above this key level of $30, and then we abruptly turned around and came back down underneath it, and we've stayed there. So that's been a bit of an abrupt shift in the silver market. When it looked like it was breaking out, it turned up its heels again. And there's the gold price in US dollars, again on a weekly chart. So not a lot of change over the last 4 or 5 weeks. If we look at Australian dollars, pretty much the same. Okay, let's go to precious metals. So gold was up $4 to $23.26, which in Australian dollars is still a very profitable area. And I can only hope that when we roll into our earnings season in August, that the results that our gold producers are putting forward will wake the market up to just how much free cash flow these guys are generating. The reality is that gold, I get questions regularly about why gold stocks aren't doing a lot better. They're at long-term lows relative to the gold price. The reality is that gold does best when markets are moving towards negative real interest rates. They don't have to be negative real interest rates, but they need to be moving more towards that area. And we're seeing a number of things that would indicate that that's likely to happen. In America, the really important number for the Fed is the Personal Consumption Expenditure Index, and of course also the CPI. They are showing decelerating trends over the last, over the last year. There is no question that those indices are showing decelerating trends. So that's a positive, and that can obviously lead to interest rate cuts. Personal incomes, so on top of that, personal incomes are up, which is indicating that the US has got a pretty robust labour market. It's a head scratcher for me because, frankly, there's so many things wrong in America that you wonder how that can be, but it is what it is. Now, if we look at precious metal stocks, the minority in Australia, there are a few select precious metal stocks in Australia that are doing really, really well. But the vast majority, 90% I would hazard a guess, are still struggling for traction, despite the fact that the outlook for gold is looking better and better. Turning to other commodities, copper was down, edged down a little bit further, so did nickel. And with copper, we've really got this situation where we've got a bit of a conflict between fund managers that are very long-term confident and bullish about copper for obvious reasons because of decarbonisation versus the current situation where demand in China for copper is not that buoyant because of concerns about the property sector. So it'll be very interesting. Obviously this is going to resolve with higher demand for copper over time. And if you believe all the studies that are done, supply will not be able to remotely keep up with that. It will resolve itself in some time, but at the moment we've got a bit of a stalemate. A bit of positive news: copper inventories in Shanghai continued to decrease the third week in a row. So that's indicating that demand must be going up. Demand is drawing down those copper inventories. So that's a bit of a positive for copper. But look, the biggest issue at the moment with copper stocks, and particularly copper developers, and in Australia we've got so few, there's really only Sandfire is really the only pure copper play that we've got of any size. So you've really got to look at the copper developers, and the market is shunning them, and probably rightly so at the moment, because funding is just such a huge issue. You know, the banks funding the projects, the equity market funding the capital to go out and drill and expand. It's a real problem, and it's what's holding these developers back. So, you know, just tone down your expectations when it comes to copper developers. West Texas Intermediate crude was up again a little bit, 81.54. Just a few quick words on lithium. There is no question there is fast progress being made in the electric vehicle space. However, we've still got a very immature pricing market. So, you know, no one really knows what's going on out there except for the absolute insiders. We do have rapidly rising supply, and that's the issue, and that's going to be the issue for a period. So demand increasing, yes, but supply increasing even faster, and that's what's holding the prices down and actually torpedoed prices again during last week. Your investment exposure to lithium is entitled to be low, and I'd even go as far as saying it should not be high, because it's very difficult to anticipate when this pickup in price is going to happen, which will then flow through to stocks. It still could be several years away yet. So you just want to make sure that you've got an appropriate level of weighting to lithium to reflect that. Really important to have a plan. What are the stocks that form that plan? Producers, developers, early stage developers. What are the entry and management techniques you're going to use? You know, the more you can pre-think the way you're going to tackle this, and this is just what I do constantly in the Insiders Club, then the better off you are. Now, chemistries are certainly evolving. There's no question about that, but it would appear that the most favoured chemistry is still going to be heavily involving lithium. We've got vehicle and battery costs are falling, so that's an important thing. And the other important thing is it's just going to require a staggering amount of money in the supply chain to make this all work. Now, to reflect the sentiment around lithium at the moment, we probably need to go no further than look at Pilbara Mines. This is a weekly chart. Now, this is an excellent company, a terrific stock, and at some point in the future, I'm totally confident that this will trade back up at a much higher price. My only issue now is I really don't have any feel at all for when that will be. And as I said earlier, it could still be years away. And you've got to look at this price chart, and irrespective of what your basic thoughts are about lithium and the future of electric vehicles, you've just got to acknowledge what this price chart is telling you. We've broken key support. We've had 5 weeks down in a row, the last few weeks on rising volume. This is a very ugly, or developing into a very ugly looking chart, despite the merits of the company. So that is why your weight into lithium should be pretty minor at this point in time. All right, wrapping it up. Above average returns can be achieved. There's no question about it, but it's not a straightforward road. You don't just turn up and you're automatically going to get these great returns. It requires organisation and a reasonable amount of it, and it certainly requires process. But the process improves your chances dramatically, so it's worth doing. It's worth putting the effort into. I really encourage everyone to just take a fresh look at how you do things. Are you buying the best of the best, the highest probability growth stocks out there? Or are you buying a selection of conventional wisdom stocks, let me put it that way? Stocks that, you know, you're told that you got to own some of these. Well, just throw all that out the window and just ask yourself, why wouldn't you just buy the best of the best and just do that? I don't understand any other position. The next point is, are you able to buy with confidence? Because I talk to many people who can't. Because they're just overwhelmed by all the fear of all the things that might go wrong, and perhaps their previous bad investing performance. The final thing that I'll leave you with is came out of JP Morgan just recently, and that is they've done a study that showed that investing cash when markets are high is unlikely to produce lower returns. Now, the conventional logic is if you invest at the top of the market or when the market is high, you will get a poor return. That's conventional thinking. And I guess if you do it at the index level, then, there are some times when you just definitely don't want to be doing that. But this study that JP Morgan did demonstrated that you should not be held back because the market indices are at a high. As long as you are buying the best of the best, you can still produce above average returns. So I'd just ask you to think about whether your investing process is just haphazard, or whether you operate by some kind of clear design. Really, really important question to reflect on. Portfolio analysts last week, we looked at staying in tune with the industry dynamics. We also looked at lithium and gold. I've thrown a lot at you today, a lot to reflect on, and hopefully you can do that. And if you are interested in what we do in the Insiders Club and Portfolio Analysts, then I'd love to have you on board. There's more information on the website. Here's my email address, and I'll be back with you next Sunday. Cheers.